Hello, everyone. I believe this is video 4 of chapter 7. So we've had a couple videos discussing interest as an expense and discounts on bonds as an expense. In this video, we're going to focus on recognizing interest as income and how this differs between individuals and corporations. So interest income. The Tax Act Section 12 both require the use of an accrual approach by all taxpayers, although different for individuals and corporations or partnerships. Corporations and partnerships requires full accrual, generally the same as required for GAAP. When it comes to recognizing interest income, corporation is easy. It's the same accrual you do anyway. That's in line with the Tax Act as well. So when I have an interest, when I pay a loan, I give a loan. Now my corporation's earning interest income. The loan might not have the physical payment every month. Maybe the interest gets paid at the end of the loan. This is something you see often with GICs and bond discounts, for example. So from a corporation standpoint, it doesn't matter if we haven't received the money because we would still do the accrual calculation from when the loan was given to the end of our fiscal year. So if the loan's been outstanding for 4 months, we'll accrue 4 months of interest and we'll record it to income even if we haven't received the money. We just tally it as interest receivable on the debit side. But for individuals, this gets more complicated because for an individual, tax returns are normally based on cash basis. So if I have a loan and that loan's going to sit for 3 years, but I don't get the interest until that loan is repaid. So at the end of 3 years, they'll pay back the loan and all the accrued interest. Now I have some interest income that's all included in 1 year. That's how it would be if we um, maintain the cash basis of accounting. So individuals are normally, we keep track of our income on a cash basis, but for interest income, we should still maintain at least a facsimile of the accrual method. So individuals use a modified accrual method where we record 1 year of interest at the anniversary date of the investment contract. Excuse me. So if we have a loan that's going to be repaid in 3 years, we recognize 1 year of interest on the anniversary date, and we will report that and pay taxes on it. The next year, we report another year of interest on our anniversary date, and then we pay taxes on it. So when that final payment comes and we get our loan and we get all that interest paid back to us, we only need to report and pay taxes on that last year of interest we've already declared the other income. So this is the modified accrual date. From corporation, we accrue, day to day. If 4 months have passed, we're accruing 4 months. But for the individual, we care about when did the anniversary date of the loan pass. So interest must be accrued on each anniversary date of the investment contract. Anniversary date is the day before the day in which the debt obligation was issued, and every successful 1 year interval. That statement of the day before the day, if I bought or if I give the loan on July 1st, then the anniversary date is June 30th, right? From July 1st to June 30th, that's 1 full year. So they say the anniversary date is the day before the day, is because whichever day the loan started, the anniversary date would be the end of the tax year the day before. So July 1st, the day before is June 30th. If I give a loan on October 16th, the anniversary date would be October 15th, that last day to finish off the year. So if a 5-year debt obligation is issued on July 1st, 2025, the anniversary date is June 30th for each of the five following years. So the accrual rules in this example, we have a 5-year, $100,000 bond issued July 1st with an annual interest of 10%. Interest payment for first 2.5 years of interest is due December 31st, 2027. The remaining interest is due paid on maturity. The corporation uses the full accrual method. The individual will use the modified accrual method. So if we assume the corporation is running on a calendar year, so December 31st is the year end for both of us. The loan was given July 1st. From July 1st to December 31st is 6 months. 10% of $100,000 is $10,000. So a year's worth of interest is 10,000. The corporation will accrue the first 6 months in that year. And I think if we go to the next one. So in 2024, it's issued on 2025. These years are slightly off. This should be 2025 onward. Yeah, I'm not going to go through the time. So in the first year, 6 months pass, so the corporation accrues 6 months of interest. In 2025, January 1st to December 31st is a full year. So they accrue a full year's of interest. They accrue a full year, a full year. In 2030, in our example, because that's when it matures, we're accruing from January 1st to June 30th when the loan is repaid. So that's just another 6 months. So we accrued 6 months, we accrue each year, and then we accrue those final 6 months. So the total interest earned, interest income, is $10,000 times 5 years, $50,000. So the corporation's very straightforward. That accrual method keeps that income recognition consistent. The individual, our modified accrual method, is combating our cash basis. So we don't recognize anything in the first year because an anniversary date hasn't passed. In 2020, in the first year on June 30th, in 2026, we recognize that first year. There's the $10,000. Anniversary date, we recognize a year's worth of income. In the next year, we recognize another $10,000 worth of income. That's our accrual. But in that second year or halfway through the loan, we got paid $25,000. So the corporation doesn't care when the money got paid, it accrues consistently. But the individual accrued 10,000, accrued another 10,000, but then they received $25,000. Cash basis says we got to recognize that 25,000. So we received 25, 10 was already recognized in the previous year. So the other 15 will be recognized up to the point that we've collected, which causes a concern in the next year. In the next year, we have another $10,000 to accrue. So by this point, 10, 10, 10, we should have reported $30,000. But we reported up to $25,000 already in the previous year. So 30,000 minus income already reported, $5,000 is left. So we'll report $5,000 here. At the next anniversary date, we've received no cash, so we just do an anniversary accrual of 10,000. And at the end of the loan, we have the final accrual of $10,000. So this method still gets us to the same total interest income, that same $50,000 that's the entirety of the interest that would have been collected. But the individual, that pseudo accrual method, is combating that cash basis. We recognize the anniversary date, but if we get money during the loan, we have to say, okay, has this money already been reported? If there's any in excess of what's been reported, we have to recognize it now, and we'll subtract it from our next recognition. So this $5,000 got moved ahead because we had received $25,000. So the exercise related to that income inclusion is here. Give the text a second. Annual accrual rules. On October 1st, Miss Chloe Z acquires a newly issued 6-year investment contract on the day is issued with a maturity value of $60,000. So we have an investment contract for $60,000. It matures September 30th, 2031, which is 6 years from our purchase date, 2025 to 2031. It pays interest at an annual rate of 8%. Payment for the first 3.25 years of interest is due December 31st, with interest of the remaining 2 3/4 years payable at the maturity date. So on December 31st of 2028, they pay out all of the interest up to that point, and then the remaining interest gets paid out at the end of the loan. So what do we do? 8%. One second, I'll go back to the question. So the face value is $60,000 and the annual interest is 8%. So every year we're recognizing $4,800. So there's nothing to be recognized in the first year, 2025, because an anniversary date hasn't passed and we also collected no money. In 2026, a year's now passed, we recognize that first 48. Another year passes, we recognize the second 48. In 2028, we get paid $15,600. That's how much money we've received. We got paid $15,600, but we already recognized $4,800 at the first anniversary date and $4,800 at that second. So the money collected, we've already reported about $9,600. So we need to make sure we're reporting what's left. So this 2028, we need to recognize $6,000. That's the income up to this point that we've received. So our anniversary date is recognizing some. When we get paid cash, we have to report the amount of cash received minus income already reported. So third anniversary is $4,800, but that additional interest amount's another $1,200, so $6,000 total. In 2029, we have another year that passed, that $4,800, but we already recognized an additional $1,200 last year. So we've already reported that $1,200. Why would we report it again? So we get to subtract it from that anniversary amount. In 2030, we collected no monies. We have one full anniversary accrual. And in 2021, we get the remaining amount of our interest. So it was a 6-year payment of $4,800 times 6 years. Our total interest income is $28,800. That's 6 years of our debt amount. We collected $4,800 of interest over 6 years. That total interest paid is $28,800. So we collected all of our interest. By the end of our interest reporting, 4848, we've recognized $28,800. So this last year doesn't need to be modified because that $13,200 that was collected was already reflected in the anniversary amounts previously reported. So that is so corporation's easy, just consistently accrual each day's interest, and that's your income. But for individuals, we have to kind of balance this accrual method, this modified accrual, with cash physically received. Now, amounts paid might not be based on how long you've had a loan. If we have a loan and it's based on production or use, this is not usually centered around bonds. This might be used where someone allows us use of a machine. So we might rent a machine for our business and now we use it. And so we don't pay rent based on a monthly basis. We pay rent based on the number of units we're producing from it. If that's the case, if the amount's already included in income through our accounting records, Tax Act Section 12 doesn't change that result. If you've already accounted for the usage of the machine, then we'll just take it. If we haven't, we need to apply the amounts received for the use of property. So we've rented out our machine. They produced 4,000 soda cans. They need to pay us a certain amount based on that production. So this is just a section of the Tax Act to say we've collected money not based on rent, but based on production. And so that still needs to be recognized as property income. So Section 9 takes precedence over Tax Act 12, meaning the accrual concept applies. This amount received only applies if an accounting record wasn't already used. So if someone's paid us for the use of the machine, we need to recognize that income. In other words, we have the accrual method. If the accrual method wasn't used, use the cash basis. On sale, so we sell the machine, additional amounts received based on the production or use are property income. So this comes into place. My business is I rent out production machinery. So a business is paying us based on the production use. But I have something in the contract that says once they have the machine for, say, 3 years, they have to buy or they pay for the rest of the machine. So it's a sale at that point. But a portion of the amount received relates not to the sale, but to the usage of that machine. So when I sell the machine, that sale price might be business, say, or capital gain, but the portion related to production is still property income. It's not part of the sales price. This is a complicated situation. We're not going to throw this situation at you. It's a funny situation that comes up when businesses are loaning machines to each other instead of funds. Okay, in the next video, we are going to discuss rental income. We're going to move off interest expense and income and discuss a bit regarding rental income. Thank you for your time. See you in the next video.